Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting today again with Michael Porter. Morning, Michael.
Yeah, morning, Rob.
We've got rid of our furry animals, and hopefully our sound is better with the new sound equipment we've got. Michael, we continue with the Middle East being bombed properly, and the war is happening there. The thing that I've been kind of watching and looking at is a combination of things. Obviously, we know oil is well over $100 a barrel, but gold is actually not run away. It's sort of sitting on the $5,000 an ounce mark. And the rand, although weaker, seems to be holding under that sort of 17. So I'm a bit confused. Maybe you can bring some clarity for me.
Yeah, Rob, the markets are taking a pounding and the Middle East is taking a pounding. So yeah, it's a dual thing there. Robin, I think it really all comes down to the fact that temporarily the dollar has regained that safe haven status. So there's a lot of turmoil in the world. There's a lot of uncertainty. No one really knows what the next 24 hours or 36 hours holds. And this will be a pretty critical week for developments for the next 10 days, because you're going to start to see some capacity shutdowns in the Middle East on the oil side if some of the ships don't start getting through quite soon. And then that's obviously going to maybe have some slightly longer term implications for the oil price. So temporarily the dollar's regained its safe haven status. So the dollar's strengthened. By implication, currencies on the other side have weakened. So the rand has weakened a little bit in relation to that. So definitely the weakness against the pound and the euro hasn't been nearly as marked as the weakness against the dollar, which just tells you it's really about dollar strength. And yes, when the dollar strengthens, then commodity prices weaken as well. So you would have actually expected gold price to actually come off a lot more. So Robin, it's come down from 5,500. I mean, but that was obviously when there were different factors at play. But the fact that the gold price is holding sort of around about the $5,000 level, I think still implies that there's a lot of demand for gold, and that those secular trends of a weaker dollar, diversification away from the US, and building up gold as reserve assets hasn't gone away at all. And I think that from a South African point of view, as much as the oil price is really going to hurt us, and we can talk about petrol prices in a moment, the terms of trade and the higher gold price, and to a slightly lesser extent platinum's also come off a little bit, are still propping up our terms of trade. So the rand is weaker, but it hasn't collapsed. We're still that net beneficiary of a commodity country. But if you just think about our terms of trade, I mean, 2 months ago we had very high gold and platinum prices, very low oil prices. That's obviously shifted a lot. So the terms of trade have reduced, and that short-term impacts on the sort of relative strength of the currency.
Yes. So Michael, one of the things that we explored, and I can't remember whether it was you or Willie, was the fact that over the last year, when the rand was in really good shape and the bond market was in good shape, our government over-borrowed against its needs. That's showing as a very, very clever move, isn't it?
Oh, exactly, Robin. We wrote about it in Intuition, and I think when we looked at the budget, the debt to GDP was 78.9%, which was higher than the 77.8% that they'd forecast. And it's like, gee whiskers, it's a whole percent higher. That's a lot in the context of where government debt is. That's a massive overrun, and it can't all be explained by the lower inflation target and things like that. Anyway, when we dug into the numbers, it was apparent that government had borrowed 38 billion rand extra ahead of time, also to fund some of the maturities that are going to come up in the next couple of years, and to boost their cash balances. And yes, exactly, their comment at the time was, bond markets haven't been this favorable for 15 years. We're making hay while the sun shines. And I think I wrote about it in Intuition at the time, is that it is so nice to see that government was being proactive and thinking ahead and not just being reactive. And yes, that's exactly, they can ease off now a little bit. Bond markets are a little bit weaker. I mean, listen, markets are weaker, but they're not as weak as they were a year ago. So everything's relative. We're still relatively in a good space compared to where we were. But yes, that's definitely, it's just nice to see them having been proactive and maybe just at the margin, Robin, taking some of the pressure off us all the time. Yeah. So it's a nice development there.
Yeah. So bringing it back into South Africa then, Michael, I mean, obviously you kind of highlighted, you used the word temporary, and the secular trend is still there. So are some of the underlying trends from a South African point of view, are they still in place as long as this doesn't go on for
Yeah, Robin, I think they
years?
are. I think probably the most disappointing aspect will be maybe the pace of our recovery, because really, I mean, I'm sure everybody's aware, you're watching the press, you're watching the local press and the headlines galore, but petrol prices are going to surge next month, you know, and we're talking sort of 4 to 5 rand a litre on petrol. I mean, 20 rand to 25 rand, that's almost the highest it's ever been. You know, I think that it peaked there in the Ukraine sort of crisis, and you're talking even more potentially on diesel. So obviously, if you look back a year to where petrol prices were a year ago and the rand oil price was a year ago, that disinflationary effect, it's not as bad. I mean, petrol prices are roughly similar to where they were a year ago. Well, the rand oil price, obviously, we've also got some tax coming in from the budget, you know, increase in the fuel levy. What would really be nice from government is to actually say, we're going to scrap the fuel price levy increase, you know, and just give consumers some respite. I mean, it's not much in the context of where fuel prices are going, but it would be quite nice for government to do their bit, you know.
Don't hold your breath.
No, don't hold your breath. That's my plea to Treasury, but I'm not sure they're going to hear it. So yeah, Robin, I think the really disappointing thing is that we are going to have this pressure on consumer spending coming through again in the short term. It all depends on how long it lasts. You know, Trump has called for allies to go and help keep the Straits of Hormuz open. It's we have to see how these things unfold. But you know, at the short term, pressure on consumer spending, no reduction in interest rates. I suppose there is a chance we have a hike in interest rates. I don't think the Reserve Bank will be quick to do that in the context of where the economy is, but you cannot rule it out. And so just all of a sudden, where we expected some moderate tailwinds over this year, they've suddenly turned into moderate headwinds, and we just have to take that into account. I don't think it derails the SA story, the reform story, the improving confidence in local reforms and everything like that, and some of what's driving rail and things like that. But you know, if businesses were looking for a consumer-led recovery just to get some momentum, that's going to be tougher. Definitely, you know, we're all going to feel it next month. You know,
Of course, the really hard part out of all this, Michael, is to know when the dust settles around what's happened. There's going to be a big change in the world order. I mean, Dubai has a completely different question mark around it. Maybe the whole Middle East. Maybe Cape Town looks much more attractive to people.
Yeah, I mean, I think it does, Robin, especially for digital nomads and those kind of people, you know. But I mean, even if you look at the Middle East, I mean, Qatar and Dubai have had very different experiences, you know, and countries that host American bases are under significantly more attack than those that don't, you know. So, yes, there's a lot of reckoning still to come. There's a lot of water to flow under these proverbial bridges. It'll be interesting to see how that all side plays out. But yeah, if you just look around the world, I mean, I think it's relatively stable. We've often commented it's nice to be at the tip of Africa, far from the madding crowd.
Exactly.
And no one's wasting a good missile down here. But you know, relative stability and, you know, in a digital world becomes interesting. I actually think what's also interesting, Robin, I mean, it'll be interesting to see if this slightly plays out in the short term. I don't think so, but you know, a lot of companies have been getting everybody back to work. You know, I think Sasol was the last big company a couple of weeks ago to announce that everybody's back in the office, and quite a few Sasol people have moved to Cape Town, and you know, they're facing that dynamic now. But with petrol prices going up a lot and pressure coming through, you wonder where that work from home doesn't become a little bit more flexible for the next couple of months again, just to give people that opportunity to absorb that and to sort of almost peg their fuel bill. You know, if you're only having to drive 2 days a week, maybe your fuel bill gets pegged at a similar rand cost because you're just doing less mileage and trying just to manage the impacts like that, and everybody be a little bit proactive. I mean, I don't think that derails the property story by any stretch of the imagination, but it might just be a way of trying to limit the pressure coming through.
Awesome. Well, Michael, thanks for giving us those insights. Thank you for tuning in. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.